Momentous family, welcome back. Today we're going to be talking about the rising prices of mortgage applications and the effects of homeowner affordability on houses today. As always, please give us a like, share, and subscribe so we can grow this message. Mortgage applications have increased about 2.5% from May to April. So what does that mean? People are paying 2.5% more on their mortgage based on a monthly rise, month over month change. That's a substantial jump. This isn't a year-over-year measurement, this is a monthly increase. So to increase 2.5% on a 12-month schedule is mind-blowing. Now keep in mind, when we are looking at this data, we also have inflation actually year-over-year decreasing. In May of 2023, the inflation actually is coming in about 4.1% as per resources in the Fed. The previous year, inflation was 8.5% at this for May of 2022. Inflation is measured on a year-over-year basis generally, and we're looking at the changes on a month-to-month basis when we look at mortgage application increases in prices, that 2.5%. What we're also seeing is the Purchase Application Payment Index, or the PAPI, increased 2.5%, and this is an index put out by the Mortgage Bank Association. They basically look at, all they do is mortgages and review the data and everything. The PAPI, or the Purchase Applications Payment Index, is a measure of the home prices, so the mortgage payment comparable to people's income. Basically what it does is compare how much they're paying to how much they're making, and these rates have gone up substantially. So they've gone up from 176.7 this year, and they've gone up substantially. In May of 2023 they were at 176. In April of 2023, 172. That 2.5% rise is really important, as we see that people aren't making more money to pay for these increasing application costs or these mortgage payment costs, but they're actually making the same amount of money or decreasing in value while paying more. What is driving this inflationary payment that we're seeing on the mortgage applications? We're still seeing a shortage of supply in the housing market. This is across almost all markets across the country. It is not localized to the major metropolitan areas. We're also seeing people actually getting their salary decreases. We're seeing employment cuts across the board. Finally, we're still seeing the Fed is keeping that inflation rate high. Interest rates are still about 6% range, give or take. And they've been up to 7, they've been coming down above 6. We're seeing some different rates going on right now, and that's really what's driving this increase in the index. And the index is important because that's what actually determines if people can actually afford the house or not. And what we're seeing is people are making the trade-off to, hey, listen, I'm just gonna save on going out to dinner and splurging and everything because I need to buy a home, I need to start a family, I need to do these different things. That's what we're seeing as the trend going forward. Now, just as some fun facts, the top 5 highest states with the Purchase Application Payment Index, or the PAPI, is Nevada, Idaho, Arizona, California, and Florida. Florida is actually at 225.3, where we just said the average in May was 176. The top 5 states with the lowest PAPI is Connecticut, West Virginia, Alaska, Louisiana, and Wyoming. I was super surprised to find out that Connecticut was actually the cheapest place, or has the best ratio of people having to pay for their mortgage and the amount of income they actually make. Being in the Northeast, it's very surprising. We would expect that to be in the top 10 or 15 at the very, very least. The next thing we're gonna go into is this chart put out by the Mortgage Bank Association. As you can see, the index has gone up substantially in the last 6 months. And we look over this year time spectrum right here, and we really see that this chart is going insane. It's going up the chart, and where is it going from here? We don't really know. It's very interesting because the index is continuing to rise. The payment application average is going up and up and up, but we see inflation going down. So we still haven't seen the market normalize across the board. Although inflation is coming down, we don't actually see that across the board on all industries. That's really just what we're seeing on the average of the CPI and all those consumer goods. But as we can see, is housing, it's still going up and up. All right, so let's wrap this video up. What we really see is that 2.5% increase over the course of a month-to-month change is substantial when we realize that that's month to month, and inflation is measured on a yearly basis. Inflation is measured year over year on a 4%. So imagine if we went up 2.5% each individual month, we would have a 15% rise in mortgage payment applications, or the average cost that people pay for a mortgage. That's quite substantial. What this all really boils down to is that buying a house is becoming less and less affordable. As that index shows, people aren't making any more money, but they're paying more for their mortgage. And eventually what this is gonna have to happen is that either people are gonna have to get paid more money to afford to live in these homes and to continue to buy these homes at these increasing prices, or we're gonna have a flat line or a deflation in the actual home prices. So home prices are going to come down, or they're going to stay the same for a little bit while the income continues to rise, allowing people to buy homes. The third factor is that interest rates go down, they come back down to the 4%, 5%, opening the door to hundreds of thousands of more buyers to actually buy homes. The fourth factor, right, that we have to consider is the shortage of supply in the housing market. What we're seeing because of interest rates, there's definitely new homes being built, there's definitely new units coming online, but it has definitely slowed the building industry because builders aren't making the same returns, they're having decreased margins on their jobs, and it's caused them to have a little bit of a fright. So it's going to be some time till we really correct this supply problem. Some markets will do it faster, others that are in more demand will take longer. That's kind of where we're at. We really hope that you enjoy this video. As always, we're going to be putting out information and data on the market, on investing, on mortgage applications, what's going on in the home market. We're also going to be putting out stuff in the building because that's what we do. That's our core. We are builders, we're remodelers, and we transform homes. We also sell them and getting them into the houses that they love and enjoy. Thank you so much. This is Patrick Robertson at Momentous, and we'll catch you guys on the next one.